Hello, everybody, and welcome to the TradFi to DeFi podcast. I'm your host, Tyler Sherwin, and I'm joined by my co-host and co-founder of TradFi to DeFi, John Tejan. How are you doing today, John?
Doing well. It's we've gone through a pretty long summer, it seems like, up to this point, but it's good to get back to creating podcasts and be able to have some conversations with you.
Yeah, I'm looking forward to it as well. I think it's interesting that we've had a long summer, and yet everyone's referring to these last few months as a crypto winter. And so I think this will be an interesting marker in history where we'll say, remember that really cold winter that happened in the summer? It's just one of those things that it just is a little bit out of place and out of time, don't you think?
No, absolutely, absolutely. Well, we get stuck on metaphors and they don't change sometimes, and you're like, no, that doesn't really mean what I thought it did. But hey.
Well, and speaking of metaphors, you drew a really fantastic metaphor for crypto, the market, and where it is today in its infancy and where it can be headed. And the metaphor that you compared this to was that of farming. So on the screen here, I have an image of a farm, and you wrote a fantastic blog post talking about crypto sustainability. And I'll go ahead and just show it here on the screen so people can check it out. If you aren't already, please do consider subscribing to our Medium page. You can find it on TradFi to DeFi if you search tradfi2defi.medium.com. And the title of the article was Building Sustainability, Lessons from Farming Yield and Cattle. And I don't know if a lot of folks know this about you, John, but you're actually a farmer.
Yeah, it's not just a crypto handle that I have, but it's actually something that I do. And just for context, I still have a day job, but I also I live on a farm and tend cattle here on the farm. So I'm kind of straddling two different areas there. But yeah, there's a lot of commonality because there's, as the saying is, there's nothing new under the sun. Systems are systems, whether it's a system of managing cattle or a system of creating a protocol in cryptocurrency. You have to have the same basic viewpoints of, and in this article, it's sustainability. And over the past 2+ years, I kind of used to call crypto winter. Well, there was DeFi summer 2 summers ago, which really kind of kicked off the whole yield farming and how to make money with DeFi outside of just buying and holding a particular coin. But as we've seen over the past couple of years, there's been successes, there's been failures, and most recently some pretty dramatic failures with Terra.
Yeah.
and specifically Three Arrows Capital and the whole dominoes that have taken down a number of funds and exchanges and things like that. And when I make that relationship to farming, it's that idea of sustainability. You can have a good year in farming if you just pour all the chemicals and fertilizers and everything in there and completely use up your land to have one big yield this year, and then you come around to next spring and you have a desert out there, right?
So why don't we touch on that for a bit, because that's the interesting argument that you make in this post. So I think the way I look at this is, as we're all sitting here licking our wounds with the market being down in this winter, and we look around us and we see a lot of catastrophic failures. We see the Three Arrows Capital contagion that spread throughout a variety of CeFi platforms like BlockFi and Celsius. And then we, of course, had the stablecoin implosion of Terra, Luna, and the entire ecosystem going down with it. Both of these events leading to broader contagion events, even bringing in the likes of players like Genesis as well. And so we're kind of sitting here seeing the catastrophic crashes and losses in that space. And we kind of look around ourselves and say, well, what has survived and what is left? Because like you had said, in farming, there's this idea that, there's the path that you can go if you want to go ahead and earn money farming cattle. and farming your fields. And then there's another path that you can go. And drew a comparison between the path that you can go with crypto, which I think we've all seen, which is this crashing, imploding explosion of leverage. And then you have this other path, which is something new and exciting. So before we talk about kind of how it applies to crypto, tell us a little bit about what is sustainability in the context of farming, and what was it that inspired you to write this post?
Yeah, basically, with and I'm specific to cattle farming, but it's the same thing with row crops, with corn and wheat or whatever. You can do it the industrial, commercial way, which has the backing of subsidies from the government to pay you for farming in a certain way. But the problem is, in that system, as a farmer, you're kind of stuck in the middle. There's a you have inputs and outputs, right? The inputs are seed, fertilizer, herbicides, pesticides. The outputs are, wheat, corn, whatever you're selling, or the same thing goes with cattle. So in that system, there are very few input makers, and then on the output side, you're a commodity, so you have absolutely no control of what the price you get. It depends on what day it is, what the market futures for cattle are. So as a business model, as a farmer, that's untenable. It's really untenable. And I didn't put this in the article. Back in, I think, 1970 or 1972, Earl Butz was the Secretary of Agriculture at the time, and he goes, either you have to get big or get out, which basically means borrow money, buy more land, buy big tractors, just get huge. It was, the economy of scale argument. Unless you're big enough, you're going to be out of business. And we saw during the 80s the failures of many family farms, the whole Farm Aid thing with Willie Nelson and Neil Young and all these other guys, the family farms, they lost everything because they didn't get big enough. And so, as a person in that space now with cattle, it's like, when I was building my house here on the farm, I said, at the time I was leasing it and I was managing cattle for somebody else. It was just a strict, lease payment I was making off of it. But I said, I'm gonna start my own cattle business. And then everybody that came out to work on my house, it's like, well, he goes, there's no money in it. You're going to go broke doing that. And so I'm like, well, how do you do it, or what are you talking about? You've done it, so what's the problem? He says, well, you buy your cows at the sale barn, you let them, eat your grass, and then you take them to the sale barn and get what you can get for them. So it was really a commodity thing. I said, and the thing I goes, whatever you're doing, I don't want to do that. Okay, I want to find a different path, because obviously this is something I want to do. But if that's a path to failure, and literally that's where 90% of the people go.
I think that's the point you made in the article. You said you asked your friends, what is the path that you take? And they described the path, and they said, is that what everyone else is doing? And they said, yeah, that's what everyone does. And so it's kind of like go big or go home. Right. That was the only path available. And yet you've managed to find a different way that prioritizes different things. And it was kind of a shifting of mindset, right?
Right, and that comes back to sustainability, because, as I said in the article, your sustainability has been outsourced to the government by giving you subsidy checks, right? Plant this, don't plant that. Hey, you had a bad year. At some level, yeah, it's great that the government is supporting agriculture, but it actually are these, like golden handcuffs. You can't do anything without the government saying that you can do it. Not much different from the financial system, right?
Yes, I thought that the parallels
the crypto's based on. And so, I basically goes, well, what do I need to do? Well, for one thing is I got out of the commodity market. I wasn't selling my cattle to the sale barn, which is basically where commercial beef people come and bid on auction on your cattle. I went ahead and went into vertical integration. I said, okay, I'm going to raise the cattle, I'm going to have them processed, and I'm going to direct market it. I'm going to market my cows being grass fed, which is a big selling point, and capture all of that loss, because you lose that money every step. I think one person I follow said there are four different phases of raising cattle. There's production, there's processing, there's marketing, and I think there was one other thing. But it said, if you're only going to be producing, you're going to miss out on the profit that those intermediaries in the system glean from the system, the processor, the marketing person, and it's like if you can do that for yourself in a limited way, you get to capture all that money that leaks out of the system. And that's where all those people who lose money at it is they're just farmers. They're not business people. Well, they are in a certain way, but they don't go direct. They don't know their customer. They never see their customer. They sell it as a commodity, and it gets out into the distribution was the other fourth thing. And it just gets out into the market, and you never see your customer. You never answer to your customer. You have no relationship with your customer. So if that relationship is not there, then there's no way you can actually charge more for what you have, right? It's a commodity.
And so you become essentially a cog in the machine, a piece in the assembly line that is ultimately subsidized by the government at the top, and on the output is a commoditized market where you have no autonomy. Right.
And I didn't want to be in that market. I mean, if you were to say, well, I'm going to go into business for myself, well, I want to go into business where I have no control on what I charge for my product. And all the raw materials that I have for what I make, I have no control over because I can only buy from two different people. That's just, nobody would design a business that way, but that's the way agriculture is on a commercial basis, And so
tell us about like the comparison then to crypto, right? So I understand that we have this commodity like product with with farming that's not sustainable, and so you've created a more sustainable path towards farming. Now, in crypto, let's draw some comparisons here, right? I think the initial promise of crypto is a more sustainable path, right? Because when I first came to crypto, the first thing I noticed was, oh, these yields are better. Clearly, there's some more efficiency here that's being gained, and clearly there's some value here if yields are so high, right? But then I think yields started to get really crazy, and then also some of them seem to be untethered in reality. And so, help me draw the comparison here. So how does this farming sustainability mindset, how does that look like? What does that look like in crypto?
Well, in farming, you get subsidies from government to pay for your, to help you get through, a tough year, to support your business. But in crypto, especially with yield farming, especially in the first iteration or two of DeFi especially, it was simply, I have a token and I'll offer you a certain amount of yield if you enter into a smart contract. And all they were doing were just issuing new tokens. They were inflating the supply of their token, which, hey, I've got 100% return APY on this certain vault that I'm in because I'm taking coin A and coin B and putting them in a liquidity pool and then staking that liquidity pool token, and it's paying me 100%. But you go 100% of what? Well, of this other token that's worth $1 right now. But
and
then they're
with the hype, it goes up in value even more, right?
It goes up in value, and they continue to flood the market with these tokens, and it's like, yeah, here, we're 100%. Here's a bunch, but in the end, that is not sustainable, right? You become a Dogecoin at that point, right? You have 1 trillion Dogecoins, and you just keep printing them willy-nilly to satisfy the market, to create liquidity for your token, to find some sort of way to get some market share or TVL. You're fighting that game, but it's not sustainable. You're just, pardon my French, but you're just pissing it all away. And then
Well, and then
the people that hold your token over time go, and with an overabundance of supply, the price is going to come down on that token, so that 100% APY you got drops to like 10%, and then pretty soon everybody just says, this isn't a good thing, and just everybody sells at once, and pretty soon you're in the negative. You've been making 100% of a negative amount, and it just doesn't, it's not sustainable. There's no way to go forward from there.
eventually the music stops.
And we've seen many protocols crash that way. Some of them have tried to correct course, and some have done a better job than others. But it just was not a sustainable way to go forward. Because
I think it's been an interesting model to try and acquire customers, right? I mean, it seemed like a good idea that would bring people to these protocols, right? And it worked, but how well did it work, right? Because one of the things we talk about a lot is this mass adoption moment that we're all searching for with crypto. And we've even written a blog post about it on TradFi to DeFi's blog post. And what's interesting about this is you mentioned the subsidy, the government subsidy that encourages this market and farming. Well, the subsidy in the crypto market would be these developers who create this token incentive, right? The native token to the platform that you're yield farming on. And that works great initially, right? When you jump into these pools and you're earning an amazing, like you said, a token that could be going up in value because the timing of the market is such that everyone is making money, and so the value goes up, right? But ultimately the music stops. And in the same way with farming, what would happen if the music stopped with the government subsidy for a bunch of farms that are dependent on that?
Right. Well, let me tell you, this is a farmer joke, okay? So I see you have a hat on. It says, so why do farmers, why do farmers, bend the bill of their hat, kind of the peak the bill of their hat? It's like, it's from looking in the mailbox for that subsidy check.
Oh, that's good. Yeah, so look at this. This is an entire industry defined by the subsidy.
Yes, absolutely. 100%. Yes. Yeah.
And that's
and actually, not to get off track, but Earl Butts that I refer to, he actually back during the early 70s, we were in the Cold War. He goes, we are going to use food as a weapon. We're going to produce so much food and control the food supply that instead of sending troops overseas, we're just going to withhold. And they did that with the Russians and the grain embargo in the 70s. And it's like, and we're seeing ripples of that now in the Ukraine, right? Not to get off topic on politics, but when a country has that much invested in food supply, and they subsidize it heavily, and that's just, I'm not saying that is necessarily as a geopolitical strategy good or bad, but for the farmer, for the guy on the ground, it forces him to do business in a way that he probably wouldn't normally, because it's like, well, if I do it this way, the government's going to pay me. If I do it this way, I'm on my own.
And don't you think that sort of perverse incentive that gets created because of subsidies has absolutely played out in the crypto space? It's a playbook that they very much adopted from other tech plays. So to draw another comparison, when Uber and Lyft were first getting started, right, they were charging very, very low fees compared to a typical taxi fare in an attempt to acquire users, right? But what's interesting is if you do some unit economic analysis on each drive that is taken with Uber and Lyft, they're actually upside down in terms of economics. And the reason for this is that these companies require mass amounts of capital from venture capitalists to get to sustainable levels where they can actually corner the market, right? And so what's happening is when you get a taxi ride with Uber, it's a lot more affordable than a regular taxi, you're actually getting subsidized a little bit by the venture capital money that was thrown into this investment. And so
Right.
this sort of upside down unit economics, meaning that the lifetime value of your customer might actually be negative. You're not actually making money off of these incremental car rides. It's a user acquisition strategy. And that's great if you're trying to get big very quickly. It's kind of like what you said at the beginning of this podcast, go big or go home, which is, what the farming methodology was, right? And so some tech companies have taken that same playbook, which is we have to get really big, we have to scale to a massive amount of users. Tech, social media companies, unicorns like Lyft and Uber and others, they have this strategy of user acquisition at all costs. Now, those economics might work someday. We'll see them maybe play out to where Uber and Lyft eventually become profitable. But I think that's a terrible business model for DeFi or financial related products. If you think about that just for a second, you're basically trying to acquire users and lose a bunch of money on them up front with some sort of yield subsidy. And a good example of this might be Anchor Protocol, which the protocol itself for the Terra Luna stablecoin UST, in order for them to earn that 20% yield, and then it dropped down to 18% and 17.5%, they were subsidizing about 12 or 15% of the yield, because really the protocol itself was only generating something like 6 to 7% in revenue. And so that remaining amount was a subsidy, right? And so that's great because it acquires a bunch of users in the short term. But in the long term, of course, when the music stops, as we've seen play out, it just can't possibly last. And so if we're looking for examples in the market of unsustainability, I think it would be that business model, right? Where you're trying to acquire users and you're actually losing money on them and you're making promises that you can't keep. I think that is extremely irresponsible, especially when it involves people's money.
Right, and really that all comes down to one area that is talked about a lot, and I think fairly well understood by most people, but it's the tokenomics of the actual protocol. What is the long-term strategy? Because you'll know that by the way their tokenomics are structured. Are they just going to inflate forever, or do they have they have an emission schedule that's stepping down over time, that they're slowly not, they're taking those coins, not whether they're taking them out of the market, they're just not throwing them into the market and putting huge sell pressure on it. We see that with Ethereum, right? They're changing from proof of work to proof of stake, and the emissions are going to drop drastically. That's going to help the value of Ethereum in the long run. That's a great strategy. If those emission schedules aren't in there and don't make sense, and they just inflate into infinity or just in an unsustainable amount, then it's probably not going to work. That's up for every person to decide for themselves by reading white papers and deciphering tokenomics. And one thing that I think goes unnoticed sometimes in DeFi, especially if you are invested in a certain protocol, is there are changes from time to time, and obviously with governance tokens you can vote on that, but you really got to pay attention when they start tinkering with the tokenomics. Is this good long term or is this bad long term? It might be good short term. Oh, we're going to burn all of our all the tokens that we get back from a certain
or we'll
fee
lock them up
arrangement or
for
something.
2 years or 3 years.
Or lock them up.
Yeah.
Does that make good sense? That's up to you as an investor to decide that. But so things are constantly changing, and you have to keep up with them, as they are in the agriculture world. I've gone through a rough summer in a drought, and you have to be prepared for that. And I think I make somewhat of a reference that in the article is, you can't just be ready for a good year and prepare for a good year. You have to be able to survive your worst year, and that's something different, I think, in DeFi. It's like, are we built to survive a bear market? And we're finding out those that did decide to do that.
Yeah, I think it's
are
becoming
we designed
clear.
what? Well, you even look in in Bitcoin mining, it's like, mining's great, and Bitcoin's at 60,000, and we're going to build all these mining farms, and we're going to negotiate these electric contracts with these governments or utilities, and we're going to buy all these ASICs and invest hundreds of $millions in these mining operations. And then it's like, what happens to the energy market? Did you plan for that? My hat's off to the Bitcoin miners in Texas, and they voluntarily shut down their operation during a high peak demand area. But they got subsidized by the state of Texas that paid them back credits
Another
for that.
subsidy. Interesting. Yeah.
Not going to talk about that.
So you bring up some good and interesting points, and I'm going to mention this other article that we wrote called "Crypto's Mass Adoption Moment," and we tried to identify a handful of reasons why crypto has not reached this major moment. And we're touching on this a lot, and that is these inverted business models, right? Where things are not built sustainably for long-term vision. And one area that you see this so often is in the NFT space. And I'll give you several good examples where, let's say there's a new token that's being created that is some sort of it's like a utility token for a game, right? And it has some sort of an issuance schedule. And in order to play the game, you have to have these different NFTs, right? What they'll often do is these NFTs then will get staked to then earn these tokens, right? Which then need to be spent in the game to have some sort of utility, right? And so in order to have utility for this token, which you're earning by staking another NFT, you need to then have something to spend it on, right? And what they inevitably end up doing is creating another NFT within the same ecosystem that you can purchase with this token that you earned by staking your first NFT. But what just happened here is that you started off with one NFT series, right? Maybe let's say 500 NFTs, and then they're earning this yield, right? But now you need to spend those tokens that you earned on something on another NFT within the ecosystem. So you issue 500 more NFTs. Well, what just happened? You doubled your supply of NFTs, and their value has gone down. And so what ends up happening is you have this horrible death spiral that I've seen play out in dozens of NFT projects that either I've jumped into or looked at or watched from the sidelines. And this pattern repeats itself over and over. And so one of the things that you always end up having to go back to is there really a there? Is there really something happening here? Are people either enjoying playing the game, or are they actually just trying to earn these yields? Because this happened with Axie Infinity, right? Axie Infinity had this massive speculative bubble of everyone being so excited about these Axie NFTs, where people in the Philippines were, earning tons of money in US dollars that was really meaningful to them internationally. And some would argue that that's a great thing, right? They were earning a living. But the game is not really that fun to play. People will tell you it's just something that they do to try and earn yield. And so when the crypto market crashed, yields in Axie went down with it. And so now you don't have as many people playing the game because it's not even fun in the first place. And so especially if there's no yield there, then nobody's going to be playing it. And so this is a bit of a side tangent for the NFT and play-to-earn GameFi space, of which I'm very excited about and normally very bullish about, is if you don't figure out a way to actually make the game fun for people wanting to play it just for the joy of playing it, you're not going to get the adoption that you want in these crypto games. Otherwise, they're just going to try and squeeze as much yield out of it as they can. And in many ways, crypto is itself its own metagame, right? People are in this space because they're wanting to earn yield. But are we creating fun and unique UI and UX experiences that make people want to stay? Are we actually doing things that push the space forward? And that's what I thought was a great conclusion to your article, which was that you said, we have to do better, right? There's got to be a better path forward. And so we've seen so many of these things that have gone wrong. What's the better way in your mind? What do you think is the solution to all of these challenges that we've seen and all these bizarre business models that have been concocted in the last several years?
Well, I'll be a little pessimistic on the whole space right at the moment, but it's time that we get that way because, a lot of these projects, protocols, play-to-earn games, whatever you want to call that, they're just iterations of the same thing over and over. It's a DEX, okay? it's an exchange, and and that exchange has a token. It's there's not a lot of innovation and originality, because frankly, when it comes to exchanges, when it comes to liquidity providers, there's two or three protocols that own that space. You're not going to outdo Curve. You're not going to outdo Aave. It's just not going to happen. They won the war. I mean, so if you're just copying what they're doing on another chain, as we've seen, has actually been kind of disastrous on some of these chains. It's like that's not the way forward. They kind of own that space. We need to come up with something else that is sustainable, that it has a use case that people are willing to buy into. Well, I shouldn't even buy into, but it's like something they can use. Like you said, a game that actually people enjoy playing.
Imagine that.
Ta-da! That. I realize the technology with blockchain and melding a game into a blockchain, or at least interfacing in some way. I realize that we're not quite there technology-wise, or we are, but just nobody's figured it out. And one of the things is, like, for the love of money, be patient. Don't be in a hurry. And this actually brings me to what my next article is probably going to be about, and I'll give a little alpha there to an article. This plays into that. With agriculture, and especially the brand that I practice, there's something called Permaculture, which is actually a design science of agriculture to make it sustainable. And the first thing that they say is, when you might even not bought a piece of property, or just looking at a piece of property, observe for a whole year. What is it like in every season? Does it rain a lot in the fall? Does it get really dry in the summer? When it gets really raining, is certain parts of your property going to flood? If you just go in there and go, oh, this is beautiful, this is lovely, we need to buy this, and we're going to build our house right there, and spring comes and your house is flooded out, right? Because you did not observe long enough. You did not take your time to understand this space. And that's really that really is more advice to a new investor, somebody coming into the space.
Oh, that's very wise.
You don't have to jump. You don't have to. And this is a perfect time. Imagine 12 months, ago, last August, we were coming out of kind of a slow summer. We didn't go up, we didn't go down. And pretty soon everything just started going vertical all the way into November, when Bitcoin hit, 60K plus, And, imagine if you were a year ago, August 1st, were a new guy in the space, and you just, hey, I'm going to buy this token and do that, and I really don't know much about it, but damn, I'm making a lot of money.
Yeah.
And then, you go through this whole cycle. Where's that person today, right now? If they even are in the crypto space, they've been damaged.
Exactly.
Because they didn't see a full cycle. They didn't see a full cycle.
Yeah.
They didn't know that I'm rich one day and I'm poor the next, and that's kind of the way it goes. So yeah, that like I said, it's a little bit of insight into the next article, but yeah. And for builders, we talked about mass adoption. We've got to get the normies out there to jump on board. And right now, that would be scary for them.
Honestly,
I think it's going to take some time.
I think it is going to take some time, and honestly, I think we need the time. The industry needs some more time to mature
Yes.
and put these guardrails in place. And I'm not even necessarily referring to regulatory guardrails, because I know that comes with its own set of challenges. But I mean more of the user experience guardrails that help people become comfortable with this new technology.
Yes.
Because right now, what we're experiencing is a lot like the .com bubble, where people heard that .com was in the title of the business, and they thought, oh, well, I'll invest in this because they're using this amazing technology. And so people are making the same mistake today. They hear blockchain, or they hear crypto, or they hear NFT, and they think, oh, it will immediately go up. And now, of course, we're seeing the reality of this, which is that, just because technology is new and shiny and exciting, if there's no fundamental business use case underneath it, there's no reason why Amazon stock should outperform pets.com. But we know that obviously Amazon.com clearly had a business model that became successful, whereas a pets.com or some of these other examples of the .com crashes had nothing underneath them that were real. And so if we have this time right now to mature as an industry, we can actually create the fundamentals that will drive true adoption.
Right, and I think that's with referring back to the original article on sustainability, and I said it can be the most innovative and impressive technology, but in that design, if sustainability isn't part of that, if they're not looking past the next bull market, then they're not going to make it. I mean, and as an investor, how do you know that they're thinking that way? Well, that's going to be kind of tough, and that's why adoption is going to be hard, because people are just a little bit gun shy. They've seen what's happened, and and with adoption, and I think that's really the main, and it's my main focus of what I try to pay attention to, and I'm very critical of a lot of things right now, because they're promising adoption, but and I'll take one instance with Bitcoin and with well, it's this payment system, and we built the Lightning Network, and we got POS systems and all these retailers, and man, isn't this great? This is going to skyrocket. It's like, you've got to convince a customer who has been spending dollars their whole life, and most people digitally spending those dollars, to say, well, I'm going to go over here and buy this other thing in order to buy my stuff with. That's a big leap, and your average person is not there yet. Nobody's made a compelling case why to. They want to talk about the blockchain technology and Bitcoin, and there's only 21 million tokens or coins, and it's like, but the average guy doesn't care about that. You're asking him to take his hard-earned money, put it in a different form, and then spend it at Starbucks, when his Apple Pay card works just fine. His Robinhood account uses just fine. His PayPal works just great. Why am I going to this other thing?
Yeah.
And man, if we don't nail that, that's just, that path for Bitcoin, I think, is not that solid, because I maybe it's just my reading of being in the United States, and we're gifted, and we have more money than most people, and that's not an issue. And maybe in the third world that is a huge issue, and I think it is, but I never hear about that. I don't hear a whole lot about that. And so yeah, mass adoption is, we've got to make a compelling case of why a person should, at least in their mind, it's risky, because they hear all these stories and say, okay, invest your money here. Well, I can go to the stock market and do the same thing. We got to have a compelling case for that. I don't know if we've made it, and we need to start making it. It needs to be an educational exercise, not a marketing exercise. So yeah, those are areas that I really want to see change in this area where we're building towards the next, hopefully bull market. But I don't even want to talk in those terms until we've got our ducks in a row.
I couldn't agree with you more, John. In fact, that's part of what inspired you and I to even start this entire thing to begin with, which is, we're looking for the fundamentals in this new space, and we're looking for what's real. And we think that there's a lot of education that needs to happen along this process. We will never reach this mass adoption moment without, hopefully, folks like you and I who can at least communicate these things and help people make sense of them. And I think your advice to observe is extremely wise. And so if you're listening to this episode, this podcast, or you're watching us on YouTube, and you are wanting to observe and to begin your journey of observing TradFi to DeFi and going from the traditional finance legacy system to a more decentralized and hopefully more exciting and free open future, then I would encourage you to please consider subscribing and following us on Twitter and Medium. So our Medium page is tradfi2defi.medium.com. We have a lot of blog posts that we post there, free educational content. We also have our Twitter account, which is TradFi to DeFi on Twitter, and we have a great thread on this very blog post. I would absolutely encourage you to take a look at the blog post that John wrote. I think it's extremely helpful and educational. And then also please subscribe to us on YouTube where you can watch more videos like this. And so, John, before we go, is there anything else that you want to add for us to go over and discuss?
No, I think that kind of wraps it up. I think we're in a period of time that I think people need to be patient. They need to be wise. They need to do some more research. During the bull market FOMO days, people are just throwing money around like crazy, and hey, I was one of them, and I paid for it. In certain
We have the
cases.
scars.
So, yeah, I got the scars to prove it. So. Let's just move forward and really do things in an intentional, purposeful way. My hat's off to the people that run the protocols. They're under extreme pressure to put out product that people want to use. I know it's not easy, especially now, and I wish them the best.
Me too. Thanks so much, John. Keep up the great work. I'm looking forward to the next blog post. And we'll see you around. Thanks so much for watching, everybody.